The UK mortgage demand is finally running out of steam. After years of ups and downs, lenders are warning that the housing market could be entering a cooling phase, not because of higher rates, because of something much steeper. According to the new Bank of England data, UK lenders expect both mortgages and consumer credit to flatten heading into the end of 2025. Let's unpack why this shift is happening and what it means if you're buying, remortgaging, or just running a business right now. The Bank of England's latest credit conditions survey shows that lenders are seeing weaker demand for new mortgages and personal loans. It's not that credit has suddenly tightened up, it's just that households are being a bit more cautious. After months of steady interest rates, people are actually hitting the pause button, not because deals are disappearing, but because budgets are being squeezed by energy bills, higher taxes, and day-to-day living costs. Lenders also expect to see credit card borrowing and unsecured lending plateau. When borrowing slows across the board, it shows that consumer confidence is weakening. For the housing market, this could mean slower sales, longer listing times, and more pressure on sellers to price more competitively. But here's the flip side. For those ready to buy, remortgage, the environment could mean more flexible lenders and sharper deals, especially if competition heats up between banks to win fewer, higher quality borrowers. So the key things that you need to know about our mortgage and credit demand is flattening across the UK. Lenders are reporting a noticeable drop in new mortgage applications and consumer loans. That's not just about interest rates, it's about buyer confidence. People are waiting for more clarity on the economy and possible rate cuts before making any big commitments. And every household are playing defense. With real wages under pressure and energy costs still biting, many families are prioritizing savings and debt reduction. The cautious spending behavior could cool short-term housing activity, but also stabilize the market in the long term. And lender criteria still remains tight. Even though rates have stabilized, lenders remain conservative with affordability checks. Expect stricter income assessments, especially for those with variable income, side businesses, or high debt to income rate. And as I said before, flat demand could mean more competition amongst lenders. When banks see fewer applications, they often sharpen their rates or improve lending criteria to attract a more solid borrower. Smart buyers who act early could benefit from any future market rebound. And the bigger picture to look at is this is a cooling, not a crash. A flatlining mortgage demand isn't actually bad news. It's the balance returning to the market. The frantic pace of 22 to 23 is over, replaced by measured demand and cautious lending. In reality, it's a sign of a maturing market, not just a collapsing one. So the key takeaway for you today is flat demand means it's not a seller's market anymore, but it's not a panic time either. For serious buyers, the time is when the smart money moves. You've got leverage, less competition, and lenders quietly competing for your business. If you're a first-time buyer and want to know the 5 biggest mistakes to avoid, check out this video over here. But that's your mortgage market update for today. See you on the next headline.